What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this afternoon. So what we're going to be going over in this video is this margin call situation surrounding AMC. Now, I know there's a lot of confusion about this, so we're going to be going over this new article that has actually come out about JP Morgan actually upping the frequency in which they're going to be issuing these margin calls. We're going to go over all of the details of this. But before we even do that, we need to define exactly what a margin call is, because a lot of people are very confused about this and exactly what the mechanics of a margin call is and how to essentially satisfy one of those calls. Now, in addition to that, we are also going to be going over exactly why I believe we are seeing the price action that we are seeing in AMC. Why have we fallen so much over the last couple of weeks? We're going to go over everything that has been going on, the psychological manipulation, the comparisons to what we saw in January, and what I think we could expect to see out of this stock in the near future. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people as possible. And the more people that we have staying up to date on accurate AMC information, the stronger our community becomes. So when we're looking at the chart of AMC for today, it has taken another significant fall. We are seeing it down about 8.5% today, trading at around $39 a share at the current time that I'm recording. A lot of people have a lot of low morale, and a lot of people are basically brushing this off and saying, well, this is exactly what is to be expected with this short squeeze play going on in AMC, and I'm just going to buy the dip, keep holding my shares, and keep maintaining my patience. Those are the two main things that I have seen. So when we come over to Ortex, one of the main questions that we have to ask ourselves, let's refresh this page really quick, is are the shorts covering, or have they actually covered? So we received that new exchange reported short interest yesterday, and it was significantly lower than a lot of people were expecting. This is nothing to be worried about, in my opinion. What we are essentially seeing here is the numbers that are actually reported to the exchange. But as we all know, there isn't necessarily a really good set in stone reporting system where we can see essentially all of the shorts out on a given stock. We are seeing with Ortex in their estimates about 85% of the total data, but there are some key pieces of data on Ortex that are going to be very important a little bit later in this video, and that number is going to be the utilization number right here, 91.61. So first, when we're going over margin calls, a lot of people think that when us content creators talk about margin calls, that means the forced liquidation or the forced closing out of positions. That is not exactly what happens. How to satisfy a margin call right here. This is taken from Vanguard's website. You can satisfy a margin call in one of four ways: sell securities in your margin account, or buy securities to cover your short positions, send money to your account by electronic bank transfer, which is essentially adding more collateral, sell or exchange Vanguard mutual funds, deposit fully paid marginable securities into your margin account. These are the different ways that you can satisfy a margin call. Now, what these different over-leveraged hedge funds have been doing over the last couple of months, when we've seen a lot of volatility in the markets, especially with AMC and GameStop, is they have essentially been adding collateral to their accounts. They are able to maintain this liquidity and are essentially kicking the can down the road in terms of these margin calls and forced liquidations. Now, we also know that they're over leveraged due to this chart right here that I have brought up countless times in my videos, and I believe that this is one of the telltale signs that we are heading towards a major market event. We are seeing the margin debt in the United States at the current time at almost $900 billion. Now, let's get into this article that has come out about JP Morgan. Now, a lot of people were speculating on the validity of this article. Either way, if this article is a shill piece or if it's actually legitimate, the information that is in this article makes a lot of sense. JP Morgan warns hedge funds to expect intraday margin calls. We also have NSCC 002 that is doing essentially the exact same thing if it is being enforced. So JP Morgan is warning hedge fund clients that it will demand they post more cash at any time during the day if their trades lose value. Now, again, this is the only source that is reporting this, and when they talk a little bit deeper down below, it's essentially talking about the aftermath of the collapse of Archegos management. So these different measures could have been put into place a couple of months ago after the collapse of Archegos. And a lot of these institutions, JP Morgan and especially Credit Suisse, who was hit really hard by this, are trying to tighten up their risk standards to try to avoid another situation like that happening again. Now, when we look at what exactly this website does, they track and visualize the public disclosures of over 120 banks, funds, insurers, corporate, and central counterparties. So we're going to have to wait and see how legitimate this article is that we are seeing here. But when we come over to another screenshot behind the paywall, we can see the JP Morgan Standard Prime Brokerage Agreement. And again, JP Morgan's prime brokerage operations is one of the largest prime brokerage operations in our financial markets. Now, we see here that none of the hedge funds that Risk.net spoke to have received intraday variation margin calls from JP Morgan, but they all fear that they will have to pay up in the future. Now, this individual says, I have worked at small firms and multi-billion-dollar firms, and this was a first. I was surprised to hear this, that JP Morgan said it would exercise its legal right to make margin calls multiple times a day. If they are actually doing this, obviously they are seeing something very significant in our markets coming very soon. Now, when we're talking about margin calls, we know that they can just satisfy those calls by essentially just adding more liquidity and collateral into their accounts. So the margin calls aren't necessarily what we're looking for, but it's the forced liquidations and the forced buy-ins of the over-leveraged positions. Now, this brings us back to something that we were talking about basically a month ago, and it's this Reddit post right here. Shout out to Lee Matt N for posting this. So essentially, this is taken from a research article, a research report from a Notre Dame professor. So short selling risks are tied to utilization. For stocks with utilizations over 75%, forced recalls, which means that the brokerages are basically saying to their clients, hey, we are closing you out of your position. We need these shares back, occur about once in every 26 days. So utilization is strongly associated with recall risk. We know that the utilization, according to Ortex right now, is at 91%. Now, when we think about these recalls, these loan recalls, we've actually seen something very similar to this happen already with Wells Fargo. Now, it's not necessarily regarding shares that have been loaned out, but this is also another sign that I want to keep bringing up to you guys, that Wells Fargo tells its customers it's shuttering all personal and portfolio lines of credit. This is signaling something bad coming in our markets in the near future. Something else about this too is that Bank of America is also rumored to be doing this as well. Now, Wells Fargo came out with this notice 2 weeks ago. We talked about this in a video 2 weeks ago, and then last week CNBC reported this, and we are still trying to get to the bottom of this and figure out if any other institutions are going to cancel these types of credit lines. If they do, that is going to be a major signal in our markets. Now, let's get into exactly why AMC has been decreasing in its share price over the last couple of weeks. Now, when we take a look at this chart and zoom out to the year-to-date chart, actually, let's pull this out to the 1 year. We saw this big spike from AMC back in January and then a fall back down. We are seeing a very, very similar event occur right here. Now, I do not think that we are going to see as much of a sell-off as we did in January because we have a lot more support behind this cause now. The fact that they have delayed this situation this far, it's just gotten more eyes on it and people are more willing to buy shares of AMC. So I do think that we are going to see a pretty significant decrease as we've seen, but I think we are getting close to the end of it. But again, anybody that's giving price targets or specific dates when we are going to see the squeeze, it's relatively impossible to tell exactly when this is all going to play out. The second thing that we need to discuss is the psychological warfare going on between the banks, the hedge funds, and retail investors. The main goal, it seems, from the hedge funds right now who are shorting AMC or over leveraged on a lot of these positions is to try to scare off retail investors. Now, the fact that we we shot up all the way to 72 and are now all the way back down to $38, $39 a share, you can kind of sense it in the community that people are a bit worried about this. But in my opinion, these types of price movements are to be expected. The goal of the funds is to try to entice retail to sell off their shares, push the share price of AMC lower so they can cover their shorts at a lower price. For those of you who are new apes who have gotten into this movement at these higher levels, I fully understand your struggle right now and why you may be upset about the performance of this stock. But what I would suggest that you individuals do is do your own research into this situation. There is a lot of due diligence out there. And I remember when I was first getting into AMC and doing all of the research that it didn't make a lot of sense to me. But once you get through and start fully understanding exactly the implications of this AMC short squeeze situations, these dips may not bother you as much because personally, I am in this play until the hedge funds cover their shorts. Now, I have a couple of indicators that are going to tell me when that happens. One of them is going to be market-wide sell-off due to forced liquidations, and those forceful liquidations of either the AMC shorts or unrelated positions are going to cause an overall market sell-off. The second is going to be hedge fund bankruptcies. We know there is a lot of manipulation going on in this stock right now, and once these funds end up having to cover, that is going to be the cause of some either smaller or medium to large size hedge funds that are going to collapse. So that is going to wrap up this update on AMC. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people as possible. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I am trading and which strategies I am using to trade them. So I hope you guys are having a good day, and I'll see you guys in the next video.